In order to calculate ratio, we need two numbers. One number is expressed with another number. Ratio can be classified into several types. Under the first one, liquid ratio or short-term solvency ratio. From the current assets, you need to deduct stock and prepaid expenses. Current assets includes stock plus prepaid expenses, but quick assets, you need to deduct the stock and prepaid expenses. Hello everyone, I am Meghna from the Department of Commerce, lecturing in Vidhyaashram First Grade College, the Temple of Excellence. We are in the Unit 2, Session 1 of Accounting. In the last class, we finished the first unit, that's Introduction to Accounting. The next unit, Ratio Analysis. This is the first session on ratio analysis. In today's session, let us know the introduction about the ratio analysis, then meaning of ratio, significance, classification of ratio, and one or two problems on ratio analysis. So, ratio are classified into different categories. So, under that we have ratios, problems on ratio analysis. Let us start today's session with introduction. Ratio is considered as one of the effective tool of financial analysis. It facilitates for interpretation of the profitability and solvency position of a concern. It is an effective tool. Ratio is an effective tool to financial analysis. It's an effective tool of a financial analysis. It facilitates for interpretation of the profitability and the solvency position of a concern. In the first unit, we learn the final accounts of a sole trader and the company. There, we find the profit or loss in rupees. But here in ratio, we are going to compare and interpret with the percentage, or we are going to compare one item or one number with another number. So, it's an interpretation of profitability, company's profit and solvency position. Whether the company have the ability to repay your debt or repay your loans. So, here it helps in interpretation of profitability and solvency position of the concern. The term ratio is understood as an one number expressed in term of another. That means one number is expressed with another number. So, in order to calculate ratio, we need two numbers. One number is expressed with another number. It is an expression of relationship between two numbers by dividing one figure by another. Two numbers, one dividing by another number. So, ratio is a relationship between two numbers. We'll interpret the results by dividing one number with another number. Meaning of ratio analysis. Ratio is a relationship between two accounting numbers. It is one of the effective tool of financial analysis. It indicates the relationship of accounting aspects like profit and sales. Two aspects or two numbers, profit and sales. You are going to divide with one another. So, profit and sales you are going to divide and you will get one ratio. So, it's a relationship between profit and sales. Ratio is a relationship between two numbers. Income and expenses. Relationship between income and expense. Current assets and current liability. Ratio is a relationship between two aspects. Either profit or sale, income and expense, current assets and current liability, etc. with each other and reflects the soundness of the concern. Ratio, it reflects the soundness or how good your company is running. So, it helps to know the financial position of the company, profitability and soundness of the concern. So, it's a relationship between two aspects and it interprets the results of two numbers. Significance of ratio or importance of ratio. Ratio analysis is an important and useful technique to check upon the efficiency with which working capital is being used in the enterprise. So, it's a technique used to check efficiency with working capital in the organization. So, it's a technique used to check the efficiency of working capital in the enterprise. It is the financial management Second point, it helps in financial management in evaluating the financial position and performance of a firm. That means it helps to know the financial position of the concern and performance of the, from the interpretation or from the results, you will get to know the performance and position of the concern. Ratio helps in cost control. The established ideal standard ratio are very useful for measuring the performance and contributes for the cost control and efficiency improvements. That means ratio helps in cost controls. How? They said ideal standards. Ideal standards for the ratio. So, it helps in cost control. For every ratio, we have a ideal standards. So, company is reaching the ideal standard, then the company is running in profit or in a good manner. It is a sound position. So, in order to satisfy that, it helps in cost control. Ideal standard ratio helps in cost control of the concern. So, it helps in efficiency in their performance. So, ideal ratio helps in cost control as well as it helps in measuring the performance of the organization. Next, it is a medium of communication of financial position of a concern. It's a medium of communication. It communicates the financial position and soundness of the concern. Ratio analysis is very helpful in financial forecasting. A ratio relating to past sales, profit and financial position is the basis for future trends. From the ratio, we will compare with the past sales, then past profits and financial position with the current. So, it helps in comparing the past data with present information so that you can improve your business and effective working. So, it helps in analyzing the past information with current information. Ratio facilitates for comparison. With the help of ratio analysis, ideal ratio can be composed and they can be used for comparison of the particular firm's progress and performance. Ideal ratio, from the ratio you can compose the ideal ratio. It helps to comparison. It helps in comparison of a particular firm progression and performance. That means you can compare with the last year ratio with the current year so that it helps in comparison and improving your business efficiency. Financial ratio are very helpful in diagnosis and the financial health of the firm. It helps in diagnosing the financial health of the firm, how good your company is. So, it helps in diagnosing the financial position and soundness of the concern. So, ratio is important in order to compare and in order to interpret the results with the past years and the present year. Ratio is a comparison between the two numbers. So, you are going to compare with two aspects. Next, classification of ratio. Ratio can be classified into several types. Under the first one, liquid ratio or short-term solvency ratio. This is the first classification. First is liquid ratio or short-term solvency ratio. It is the ratio which measures the short-term solvency position of an organization. It brings out the ability of an organization to meet its immediate or short-term financial commitments with its short-term or liquid resources. That means it's a ratio which measures the short-term solvency position of the concern. Liquid ratio means it is the measurement of short-term solvency position of a concern. How much short-term or liquid assets your company has and the liquid liabilities. It compare with the liquid assets and liquid liability to meet the short-term or immediate requirements. Such ratios are highly needful for the parties like creditors, bankers and other private lenders. So, this liquid ratio is important for the creditors, bankers and other private lenders because they should know the ability to repay the money or they are lend the money for the short term period. So, they should know the short term solvency position of your concern. They need to decide whether to lend or not. So, by this ratio, short term solvency ratio or liquidity ratio, they can decide whether to lend for your company or not. So, it is important for the creditors, bankers and private lenders. within 1 year, company has the ability to repay your debt or not. It shows that the company position to repay your short-term debt. So it is important for the creditors, bankers and private lenders. It enables the lender to know the repayment ability of an organization within a short period. So it helps to know your repayment position in a short period. Liquid ratio can be broadly classified as follows. This liquid ratio are classified into 3. First one, current ratio, asset test ratio or quick ratio or liquid ratio. We have 3 names for the second one. Either you can call it as asset test ratio or quick ratio or liquid ratio. In your exam, if they ask you asset test ratio, it's nothing but quick ratio or liquid ratio. Any of these names they can ask you. Find out the liquid ratio or find the asset test ratio or quick ratio. These all 3 are same. Next, absolute liquid ratio. According to your syllabus, you have current ratio and asset test ratio. Asset test or quick ratio or liquid ratio. Liquidity ratio signifies the short-term financial capacity of an enterprise and clearly reflects the short-term solvency position of the investors, creditors, bankers, etc. So, it shows the liquidity ratio. It reflects the short-term solvency position of the concern. So, mainly the liquidity ratio will prepare or will find the liquidity ratio in order to know the short-term solvency position of the concern. So, these ratios are explained in detail. Let us look at first current ratio. Current ratio is a ratio which is computed by taking into consideration the current assets and current liability. Taking into consideration the current assets and current liability, we are going to calculate current ratio. Current ratio is equals to current assets by current liability. What is current assets? Current assets includes what? And current liability. Current liability includes what? Let us see. Current assets includes cash in hand, cash in hand, cash at bank, bills receivable, outstanding income, prepaid expenses, debtors, stock. These all are current assets. Current assets includes cash in hand, cash at bank, bills receivable, outstanding income or prepaid expenses, debtors and stock. Then current liability. Current liability includes bills payable, then creditors, outstanding expenses, provision for tax, and bank overdraft, and proposed dividend. Current assets includes cash in hand, cash at bank, bills receivable, outstanding income and prepaid expenses, debtors and stock. Then current liability includes bills payable, creditors, outstanding expenses, provisions, provision for tax, bank overdraft and proposed dividend. Consider all the current assets divided by current liability, total current assets and total current liability. In balance sheet, we get all the current assets and current liability. Dividing current assets from the current liability, we'll get some ratio. So, ideal ratio for current ratio is 2:1. That means current assets, for every 2 current assets, 1 current liability. So, your asset should be more than your current liability. So, then your company is in sound position. So, your firm in sound position or good position. So, this is the ideal ratio. We are going to compare with ideal ratio and the actual ratio to interpret the results. Just look at one problem on current ratio. B.C.A. Limited provides you the following details. You are required to compute current ratio and comment on its position. Comment on its position means compare with the ideal ratio and you should give whether the company is in sound position or not. This is all about current assets and current liability. Before moving on to the problem, just first you need to classify between the current assets and current liability. Stock is a current assets, debtors, current assets, bills receivable, current assets, bills payable, current liability, cash at bank, current asset, then overdraft, current liability, outstanding expenses, current liability, short-term investments, current assets, cash in hand, current assets, then sundry creditors, current liability. First, you need to classify between the current assets and current liability. Next, just write the formula. Current ratio is equals to current assets and current liability. Here, we have classified between the current assets and current liability. Write down all the current assets. Stock, debtors, bills receivable, short-term investments, cash in hand and cash at bank. The total of all the current assets is 4 lakh. The total of current assets is equals to 4 lakh. And write all the current liability, bills payable, outstanding expenses, overdraft, then creditors. The total of current liability is 2 lakh. Total of current liability is 2 lakh. Now write down current ratio is equals to current assets by current liability. 4 lakh divided by 2 lakh. 2 or 2.1. That means 4 lakh divided by 2 lakh. You will get 2. Current ratio is 2 or 2:1. Either you can write 2 or 2:1. Now, you need to comment on its position. From the above calculation, it is evident that the company has satisfactory short-term solvency position since its ratio is 2. The ideal ratio for current ratio is 2:1. For every 2 current assets, 1 current liability. So, your ratio is 2:1. So, it satisfies the ideal ratio. So, the company satisfy the short-term solvency position. Your company in good position or sound position. So, you need to comment like this. So, write a comment based on the ideal ratio. First, you need to compare with the ideal ratio. Then, write the comment on the current ratio. So, this is all about current ratio. Next, asset test ratio or quick ratio. First classification under ratio is liquidity ratio. Under liquidity ratio, we have 3 ratios. Current ratio, asset test or quick ratio or liquid ratio. Third one, absolute quick ratio. Second one, asset test ratio. Formula is quick assets by current liability. Now we know what is current liability. Current liability includes creditors, bills payable, outstanding expenses, bank overdraft, other expenses like provision for tax. That means current liability, bills payable, creditors, bank overdraft, outstanding expenses and provision for tax. Now, quick assets. Now we know the current assets. But quick assets. Quick assets is same, but you need to deduct stock and prepaid expenses. From the current assets, you need to deduct stock and prepaid expenses. Current assets includes stock plus prepaid expenses, but quick assets, you need to deduct the stock and prepaid expenses. So the current assets includes cash in hand, cash at bank, prepaid expenses, stock, then debtors and bills receivable. Current assets includes all this, but from the current assets, you need to deduct stock plus prepaid expenses. Now, the quick assets divided by current liability is your quick ratio or acid test ratio. The ideal ratio for acid test ratio is 1:1. So, you need to remember the formula and ideal ratio for acid test ratio. So, the formula is quick assets divided by current liability. Quick assets is equals to current assets minus stock plus prepaid expenses. From the current assets, you need to deduct the stock and the prepaid expenses. Just solve one problem on acid test ratio. From the following, compute quick ratio of an organization. Cash in hand, cash at bank, stock, debtors, prepaid expenses, bills payable, creditors, outstanding expenses, bank loan. This is the problem. First, before going to solution, first you need to classify between the current assets and current liability. Cash in hand, current assets, cash at bank, current assets, stock, current assets, debtors, current assets, prepaid expenses, current assets, bills payable, current liability, creditors, current liability, outstanding expenses, current liability, bank loan, current liability. So now, just write the formula. Asset test ratio is equals to quick assets by current liability. Now we know the current liability. Write all the current liabilities. The total of current liability is 55,000 and we need quick assets, not current assets. So quick assets is equals to current assets minus stock plus prepaid expenses. The total of current assets is equals to 45,000. From the current assets, you need to deduct the stock. The stock amount is 15,000. Then prepaid expenses 2,000. Here just make a total 5,000 plus 3,000 plus 15,000 plus 20,000 plus 2,000. 15 plus 5, 20, 20 plus 20, 40, 43,000, 45,000. So the total current assets is equals to 45,000. Total current assets is equals to 45,000. From the 45,000, you need to deduct stock 15,000 and prepaid expenses 2,000. 15,000 plus 2,000. 45,000 minus 17,000 is 28,000. Now we have quick assets and current liability. The 28,000 divided by 55,000. The quick ratio is 0.51. Quick ratio is 0.51, but the ideal ratio is 1:1. Now we have 0.51:1. So this is our quick ratio. So ideal ratio is 1:1. That means for every one quick assets, you should have one liability. But quick assets is 0.51. Your quick ratio is not satisfy the ideal ratio. The quick ratio of this organization is 0.1, which is less than the ideal ratio, that is 1. It indicates that it does not have sufficient resources to meet its immediate obligation, and hence it is advisable to take the necessary steps like increase the investment in the quick assets of the concern. That means your ideal ratio is more compared to your actual ratio. So you need to take the necessary steps, that is you need to invest in quick assets to meet the immediate obligation. Quick assets you can immediately convert into cash. So you need to invest on quick assets. It is advisable to take the necessary steps like increase investments in the quick assets of the concern. So here advice is to improve or to invest more in quick assets. So in the same way, you need to write the comment based on the ideal ratio and the actual ratio. Compare with the ideal and actual ratio and write the comment. If it is satisfied, then the company is in sound position. If it is not satisfied, then you need to advise how they can improve their position. So this is all about acid test ratio and current ratio. So let us continue with the next session with the remaining ratio. Until then, keep watching. Thank you.